what do we want to call this? Okay, he's got it recorded. All right, we're going to record this. Got 41. We rebooted the room, so there's 41 people in here tonight. Uh, I'd like to see more than that. I'd like to see a lot more than that. And I think we can get there again. Knowledge is power. You know, we got to get the people that don't understand what's going on to understand this stuff. So that's the reason we do these webinars. I do them. Leonard does some of them, and Lloyd does some of them. You know, and all those are the perks of being here. And you guys are actually here for a very inexpensive cost to be here. So take advantage of it. One thing I may do a little bit different tonight than I normally do. Normally I just sit and talk and talk and talk and talk and just assume everybody's just listening, and hopefully they're soaking it up like a sponge, or they're absorbing it, or they're learning something, you know. And then at the end of the night I feel good and I'm like, okay, great, somebody had to learn something out of that, or they wouldn't have been here to begin with, because they aren't here just because they feel like hearing me run my mouth. So what I want to do a little different tonight is I want to try to get whoever is here to get a little more interactive and get involved in it, so that and there's no stupid answers. If you're here to learn something. Maybe, like I said, you're not here just to hear me talk. So if you're here, you're probably here to learn something. So I'm going to ask you guys to participate in that. I want you to give me some answers and stuff, and that will make you guys learn. You know, maybe other people will learn from it also. So again, very important. You can't give a stupid answer, okay? Because if you knew all this stuff, you wouldn't be here to begin with. Lloyd's here; he knows this stuff. Leonard knows it, and I'm sure some of these other members know it. But you know, a lot of people are aggressive and they want to try to learn all the time. So if there's anything they can learn out of this and they have nothing better to do, they'll be here tonight. So I want you guys to get involved. And when I ask a question, give an answer. Take a guess. Take a shot at it. Nobody's going to say, "Well, that was a stupid answer," you know, because it's just not. There's no stupid answers. You know, you can take a test in school, in college or high school or whatever, and unless you're a 100% A+ student, you know, you can't look at everybody else as being stupid because they made wrong answers. You know, they're just not a 100% A+ student. They're there to learn. That's why they're in school. Maybe you don't belong. So, you know, throw your answers out there. Take guesses at it and stuff. You're going to learn from a wrong answer. If you just sit and listen, you may not learn a whole lot. All right, so like I said before, not everybody in this room trades options. I know a couple people in here that primarily trade stocks, and you guys know of one for sure. I know Tim. I don't think he trades options at all, and it's great that he's still here though to you know, get involved with the members in the room and what the value is and what's added, and you know, what he can learn from it. But again, like I said a minute ago, I'm not exactly sure, and there's various reasons why they may not trade options. It could be because they can't get approved for options. That could be a reason. Maybe because they don't understand them. They haven't taken the time to try to understand them. They may not trade them for that reason. There could be a whole bunch of reasons why they don't trade options. So what I figured tonight is I'll make it pretty basic. I don't want, you know, some of you guys are going to, sometimes when I get a class going like this, the more educated ones, they pop off and say stuff like, well, you know, how does implied volatility come into this? How does the Vega come into it? Where does the row? Where does the insurance, you know, interest rate change? I don't want to go there. My objective is to try to start ground level and bring you to a decent level of understanding, not to show you that I know a whole bunch of stuff and bog you down in your head with a bunch of stuff that's really kind of irrelevant to what we want to teach the room here. So if you guys are one of those, hold that stuff to yourself. I'm not going to answer that kind of stuff tonight among a bunch of people that are trying to learn the basics of spread trading and credit spreads and debit spreads and stuff like that. All right, with that being said, I cleaned this thing up tonight. I ran a utilities on it, and I did a disk defrag. I'm getting a lot, up until hopefully tonight, I'm getting a lot of the flash crash, the Google flash crash. Google Chrome, which is the browser I use, and I tried to use Firefox, and it was doing the same thing, not quite as bad, and I didn't like Firefox. Google Chrome has its own flash built into it, and these forums have what's called Adobe Flash. Adobe and Google Flashes do not like each other for some reason. So if you guys are running both, you're probably getting the screens freezing up. You're getting a little yellow box that says, you know, shockwave crashed your computer. Last night when I was talking to Lloyd, I got 4 of them in less than 10 minutes. So I'm hoping that I've done something in here tonight to avoid that happening, because that's really frustrating. So if it does happen, doesn't mean I'm done or I left. It just means I have to restart stuff, and I'll be back and I'll get the screen sharing going again. All right, to start off with, real simple. There's different option levels or tiers that a lot of the brokers require, and in the case of interactive brokers, if you get approved for options, you're approved for all of them, meaning you're covered for all the levels. I don't know of any other brokers that actually do that. Most of them, they put you in what's called tiers. Okay, if you're a tier 1 option trader, that means you can sell covered calls on underlying stocks that you own. So if you own 100 shares of Apple stock, you can sell, $100 or what's it traded, 97 bucks. You could sell $99 calls against those 100 shares, one contract being equal to 100 shares. You can sell covered calls each week. They have weeklies against the 100 shares that you own and collect the premiums on that, or have your shares called away. They allow you to do that, and that's the first tier level of options approval, and it's safe for them because if you screw it up and you get your shares taken away, you're not getting assigned or exercised anything because you own the underlying shares. So it's relatively safe for the broker to allow you to take 100 shares of anything that you own and sell covered calls on it, and you collect premium, and the strikes actually go worthless, and you keep the premium, or it goes in the money and you get your 100 shares called away. So easy peasy, they can play that game and let you play it also. That's the first level. The second level, I've never quite understood why the brokers got on board and allowed this. The second level of Tier 2, called Tier 2 in options trading, is going to allow you to be able to buy puts and buy call options, okay? Actually kind of a foolish way of trading that they allow new options traders to be able to have if they're just starting out, because it's one of the most difficult types of trading to actually make work. And I don't know that it's always been that way, but now it is. And so why all the brokers got on board and said, here, let's let them have Tier 2, and most people can get approved for that. And that allows you to buy puts and buying calls. But those are hard to make work, and I don't know why they're keeping that system going. The next level is Tier 3, and with Tier 3, you can actually buy calls and puts, but you also have the option now of selling options. Okay, that's going to allow you to be able to sell calls and sell puts, which is going to position you to do what you're seeing being talked about a lot in the room, which is spread trading. Okay, if you're going to do any spread trading, whether it's credit spreads or debit spreads, or if you're going to do iron condors or butterflies or any of the little more complex stuff that is involved in options, you're going to have to go to your broker, and you're going to have to ask them to approve you for what's called the Tier 3 options trading. That's the level you will need to participate in any of these trades that are being discussed in the room that are more than just buying a put or buying a call. You will have to get that. So that's the first thing I want to let you guys know. I know some of you guys are just stock traders, not options traders. You're going to need to do that. You're going to have to go to your broker. You can usually apply for it online. They're going to want to know if you're doing it for hedging or speculating or blah, blah, blah. I haven't done it in many years, so I don't remember what all they ask you. But just tell them you got lots of experience, because they're not asking you how much experience you personally have in your head of trading. They're asking how much experience you have. Well, you got 20 years, because you surround yourself with guys that have 20 or 30 years of experience every day that you're in this room. So you're not lying to them. So tell them what you got to tell them to get approved on, so that you can get involved in some of the trades that are going on in here. All right, if you look at the screen, go over to the right-hand side here. Everybody understand what tier level you got? Oh, and you can get a level 4, by the way. Again, like I said, Interactive Brokers gives you all 4 levels automatically if you're approved. But like Thinkorswim, I think you have to get approved for each level. If you get a level 4 approval, a Tier 4 approval, then you can do what sometimes you'll read in the room when people say, hey, I know, Lloyd especially, hey, I naked sold some puts or naked sold some calls. That's what they're talking about. You have to be approved for Tier 4 with your broker, because it's the riskiest, that's the word, the riskiest level of options trading that's available, in that it's one of the few types of options. You'll see people post in a room in the different forums and say, well, I like playing options because your risk and your reward is always defined. Well, that's nearly true. It's usually defined. If you're a level 4, Tier 4 options trader, and you can naked sell stuff, how they came up with that word, I'm not exactly sure, but if you can naked sell stuff, then you've no longer defined your risk. You've got unlimited risk, actually, and that's the most dangerous type of trading in options. So yes, when you're trading options up to level 3, your risk is always defined and your reward is defined. With level, if you're trading at level 2 and that's the max you have, your risk is always defined. Your reward is still unlimited, potentially. In that you're just buying a call, and if you buy a $100 call and the stock goes to $150, then you're up $50. So you have an unlimited or no ceiling on buying puts and calls. Puts you would, but on the calls you don't have any ceiling. So you have unlimited reward, but you have a defined and limited risk. With the level 4 naked selling, you give up that risk by allowing yourself to expose yourself to potentially having, unlimited risk. So don't be so quick to do it. You got to know what you're doing. Lloyd knows what he's doing. So when you hear about him saying, "Hey, I'm gonna naked sell an $8 put tomorrow on UVX because or UVXY, I don't mind owning it there." Essentially what he's saying is, I'm willing to risk getting UVX assigned to me at $8. But he's got several things that he does that surround that. So if you take that for face value and you're not a skilled trader, you're going to get lost in the confusion of a risk that you don't want to take. And I see a lot of people posting in the room, "Hey, now what did you do again? You did a straddle on UVXY." Well, when he's selling a straddle or selling a strangle, that's a high risk position, but he understands that and he knows how to play it. Unless you do, don't take on that challenge. Last week when he sold or 2 weeks ago when he sold a UVXY straddle at the 15 strike, and he collected $2. That gave him upside protection to the 17, and it gave him downside protection to the 13. Okay, but in conjunction with that, he's got other stuff going on. If he gets assigned that on the low side, if he gets assigned that UVXY, he doesn't care. He'll sell covered calls on it. There's a lot of things that can be done, but it's important that you understand these and that you also have to do them. Don't get yourself into a trade that you don't understand in options, especially one like that. I'm going to give him a second here. He wanted to make a comment on that. But it's real important that you stick with the trades that the risk is defined. And if you get into a trade that you're following, either Lloyd or myself, Lloyd loves to play that stuff. And I understand why. I play it too, but I don't share it with the room. If you're going to get into that stuff, make sure you understand what you're getting into. And always understand your risk and your reward side. Don't get into a trade blindly and not really know how it's going to make you money, especially one that has an open-ended risk, because that's going to hurt, and they can bite hard. I've got Thinkorswim show and toss. That's what's on the screen.
Hey, Moto, can I make a comment?
No.
Can you hear me?
Yeah.
Can I make a quick comment? When I sell naked, right, everybody here, you have to understand, I am 100% okay with that assignment. And if you ever sell something naked and you're not okay with the assignment, don't even think about doing it. You should always assume you're going to get assigned. For example, I sold 83 calls naked in CRM. I collected 60 cents. I was okay with that assignment. I got assigned. Today it dropped to $82. I covered, right? But if you're not okay with that assignment, don't do it. And you also, if you're selling calls naked, you always have to go look and see how hard it is to borrow those shares. You do not want to be selling something naked that you're going to get assigned and be paying 100% borrow fees on this, okay? You guys all understand that though. And I do it on the Twitter feed only because there are many people on the Twitter feed that like to sell premium naked. And I really pick stocks I am very, very comfortable with. Selling naked means I am selling a call or selling a put. Usually most people are okay selling puts. Like we sold puts on Twitter. We sold the 14 July puts and collected, I think, 65 cents in premium. It's pretty much worthless right now, and we didn't own the stock. Okay, I like to sell puts when a stock drops. I feel it basing. I don't mind owning Twitter at $13.40. Right? We sold the 14 puts. We collected 65 cents the first week in July. I have no problem in owning Twitter at $13.40 average cost. Right? I really don't. But if I can make 65 cents on it per 100 shares, $65 per 100 shares, and I don't have to own it, you know what? I'm going to take a stab at it. And then if I get assigned it, like Moto says, I'm either going to wait for it to go up, or maybe I'll write a covered call. And if it gets taken away, it gets taken away. Okay? But you got to be okay with that assignment. I was okay getting assigned CRM short. I was okay getting assigned Herbalife short. It didn't happen. But if you're not, don't even think about doing it. Okay? I just wanted to say that, Moto. And the reason I do it is on the Twitter feed, there are some clients with decent sized accounts who like to sell premium, both naked and, as Moto's going to explain, on the spreads. And I like to do it too. So, okay, sorry, Moto. I just wanted to really say that you got to be okay with that assignment. And if you're not okay with it, don't even think about it.
First flash crash. There it is. I just got a flash crash, but it didn't follow through. It stopped the plug-in. So, right. So what Lloyd's telling you, for the most part, the same thing I'm trying to tell you here is understand your risk. How does one go against you? Let me give you an example. Let's just say what's UVXY trading at? $10. Say you sell an $8 put and it pays a couple bucks, okay? And what he's trying to explain to you is he's willing to take the chance, in this case, of being assigned those shares at $8, okay? Because he's getting paid $2 premium. Let's just say, for purposes of understanding, that he's getting paid $2 for that put contract. And he's saying if it goes to $8, I'm willing to take those. And when we talk about assignment, you get those handed to you. So in the case of a stock, you're going to actually get the stock assigned to you. In the case of an ETF or a SPY or something, you're going to get that assigned to you. And you're going to own it. So that's another thing you have to consider. You don't want to put yourself in a position where you can get an assignment that would require you to have a whole bunch of margin just to cover it. Because now you're sitting on something in your account that your own dollars does not even cover. And you're assigned it on margin. And don't kid yourself. You can be assigned stuff even if you don't have the money, if your margin will cover it. I get assigned stuff all the time. I've got the money to cover it. But I'm going to get into that later, what happens. So whenever you open up the door of selling anything, when you buy a call contract and you pay the premium, and you always hear them say, that gives you the right but not the obligation to exercise that. Well, that's true up until expiration. So if you bought a call contract, you have the right to purchase that stock or whatever it is, an industry or whatever it is, at a certain price, and you paid a premium for that. Now, if it goes in the money, you lose that right and you obtain the obligation. You're going to get that exercise to you. So keep an eye on your options. If you don't want the shares or whatever it is you're trading and you do not want to own it, then if it goes in the money, then play it for the premiums that you're getting. If you paid 50 cents for it and it's at $1.50 and you got 10 contracts, take $2,000. Take your money in the premiums. And even if they go in the money, you still have the right but not the obligation to exercise those. Okay, even when they go in the money. If you bought a call. However, once you start becoming a seller, whether it's puts or calls, you lose that right. Okay, you've given that right to someone else, is what happens. They have it, right? The other party has it. So you always take the risk of an assignment. Now, when you play, I'm going to show you how to play out of the money stuff and some at the money stuff and some in the money stuff. When you play in the money, it skews a few things. Your probability goes down, your risk goes down, your reward is much better. But you do risk an assignment. I play a lot of deep in the money stuff if I have some conviction of what direction I think things are going and where it should be going. And you guys will understand that a little better here in a little while. However, the flip side is when I sell that deep in the money option, whether it's a put or call, I've given someone else that right. And because of that, I can be assigned that at any given time. And it happens quite often to me. And in fact, I laugh about it with Lloyd. I'm like, they must have my account flagged or something. Because anytime I do in the money something, it always gets assigned to me. And I'm okay with that. My account can cover it. But you lose a little bit of your flexibility. I got assigned the AAL last couple weeks ago or last week. I did a deep in the money 87. I got paid 87 cents on a put spread, and my objective was to keep the full 87 cents and have the thing expire worthless. I only had 13 cents at risk. Low probability trade of success. Halfway through the week, they assigned me, when the thing went to so deep in the money that my 87 cents went to $1.04, which is actually more than it can actually max out at, which should be $1, the difference between the two strikes. They assigned them to me. Well, it wasn't my choice. I considered maybe keeping the shares, thinking, okay, do you really want to? I did 10 contracts. I was risking 130 bucks to make 870 if that thing went up. If AAL went up, those puts that I did the spread on would have gone worthless, and then I would have made $870 on the trade. I needed it above 36 or something. That didn't happen. Not even close. I didn't even thought about it. But that was the risk I took, and in that particular case, I did get them assigned. But then I thought, well, maybe I want these shares. Maybe this thing is going to go up. And then as the week progressed, I still had the option of, you got to remember, I bought puts and I sold puts. They assigned my short puts. However, even though I had the shares, the max I can lose on the trade was 130 bucks on 10 contracts. Okay, and that's if it stayed under the one strike, which it did. And so I had the entire week to think about if I wanted to close my long position that I bought and actually keep the shares. And then on that Friday, I thought to myself, I didn't make this decision that I wanted 1,000 shares of AAL. I opened up a door by selling an in-the-money put spread to getting those assigned to me, and I did get them assigned. And so someone else made that decision for me. And so I told myself, I'm not going to. Yeah, actually I did. I was getting to that, Lloyd. You and I talked about this. And then on Friday I decided, wait a minute, this is not how I wanted this, I structured this trade to work for me. I didn't want to cover my long stuff and keep 1,000 shares of AAL. Someone else made that decision for me. So what I'm trying to explain here is that's the risk you open yourself up to when you do these deep in the money credit spreads. And I'm aware of that. So what I did is I let the trade expire because the long position that I had actually took the 1,000 shares back away from me. And that's when I realized the $130 loss on the trade. So on Friday, I just left it alone. And because I had a bought put against the short ones, when you buy a put and it's in the money and you pay the premium, the exchange has to take those shares from you. They have no choice. So if you do a credit spread on the put side, and you get assigned the short leg, you've bought a long leg also, so they have to take those from you. So you got two choices. You can say, do I want to cover that leg and keep the shares, or in this case, do I not want to? So do I want to just let it run through expiration and let the long puts which I bought take those 1,000 shares back away, which is what I did. So I realized the entire loss of 130 bucks on the thing. So, but I was okay with that. Again, I had my risk defined. Let me show you the side, and we're going to get into the basic stuff. I know this is a little complex what I'm talking about here, but you guys can listen to this video again later on, and this stuff will start to make sense to you after a while. Once you will read stuff people are doing in the room, and you start to understand these option trades a little bit better, you're going to say, okay, I'm glad he talked about it, even though at the time it seemed awful complex and something I didn't understand. A month or two from now, you may say, I remember Moto said that. Now that makes a lot of sense. So that's what I'm trying to accomplish here. So UVXY, let's use it as an example. I started. Let's say Lloyd sells an $8 put. He gets $2 for premium. or say he gets 260. It's going to have some inflation there. He's saying I'm willing to take UVX at $8, and if I get paid $2 for that, then I'm down to $6. That I'm actually okay. Well, in the unlikely event, let's just say the market just loves everything that was said for 2 days, and it goes up 600 points, okay? And UVX goes down to $1, and they reverse split it. There's where the risk came in. Lloyd got paid $2 to get shares assigned for $8, okay? So he had, say, he did 10 contracts, and I use Lloyd because he plays this one a lot, and he naked sells and puts on it. So if someone else in here was doing it all the time, I'd be using you. So, now he's in a situation where he's had those assigned to him for $8. He did 10 contracts, so he's got $8,000 wrapped up in that thing. He got paid $2,000 in premium if it paid $2, and he got them assigned to him at $8. But let's say in the unlikely event the market jumped $600 or 600 points, and UVX opened up the next day at $1, and news hit all the boards that they're going to reverse split at 20-1 to get the thing back to $20. Well, therein lies the problem. Now he's sitting with 1,000 shares of UVX that he has $6,000 in, and it's only worth 1,000. So by selling his cap or ceiling on risk, he's down $5,000 the next morning on that position. Now, it's not likely to go like that, but it can. And I've been modding rooms a long time, and I've seen it. And I've had a lot of stories I've heard over many, many years, and they come crying in the room and say, "Hey, Moto, this is what happened. What the heck do I do to salvage this?" The answer was back up a week and don't make the trade because you didn't know what you were getting into. All right, enough about that. I got SPY up on it. Any question? Well, I won't ask questions yet because there's probably a lot of questions on that. Let's look at SPY. All right, if you look on the right side, if you take the little bar and scroll it over, get over to the right side of my page, you'll see that I have an options chain open, and I have it open on SPY. I'm not using tomorrow's expiration because that's going to be, the numbers aren't going to be of a whole lot of value. I want to use next Friday's expiration. Get smart and buy back the long leg. The trade goes. Yeah, you could get yourself in a pinch multiple times on that stuff, and I've had it. I've sold covered calls on stocks that died, and I tried to play that, and then about the time you start selling covered calls on one, after you get the shares put to you, they get called away way under what you actually had in your shares. So, right. All right, what I have on the screen here on the right-hand side, if you scroll over, are the options for next week Friday's expiration. They have 8 days to expiration. All right, if you're a Tier 2 options player and all you can do is buy calls or puts, here's your options, okay? If you want to play at the money, it's trading $210.91. Let's say, and again, don't take me that I'm telling you which direction, because I know my PMs are going to start blowing up here in a second. People are going to say, well, oh, so you think SPY's going up, Moto? No. I'm giving you references for class purposes to understand how things could happen. I'm not recommending SPY's going up, down, sideways, or anyway, nor am I in this class with any stock. Okay? So let's assume you think from your charts and anything, your technicals and whatever it is you looked at, you think SPY's going to go up. Okay, so if you'll look at my screen here, there's a blue line on there. It's trading right at 211. So when somebody posts in the room that an ATM, they're talking about at the money options. Okay, so for next Friday, what's it going to cost you to be able to play at the money if you're a tier 2 trader, option trader, and you can only buy a put or a call? Well, in this particular case, to play at the money at $211, you're going to have to buy $1.15 as a mid. A 113 is the bid, 118 is the ask. I'll circle it so you guys can follow where I'm talking about. There's the ask on that 211 call and the bid. So the mid's about 115, so the minimum you can play is one contract. So you're going to have $115 on the line on that trade minimum. That's the least amount you can play if you feel like that thing's going to go above $211. Okay, it's trading at $210.91. So let's say you're not a $115 risk taker. Okay, let's say you're a $50 risk taker. Well, then you're going to have to scoot yourself down here to an out of the money call, which is the 212.50, and it's 46 cents on the bid. Yeah, I got a little cursor going around. Can y'all not see that? I'm circling it inside. I see it on mine. I got it open on mine too, so I can see. All right, so at the money is $1.18. You do one contract, you got 100 shares, you got $115 in that trade. Okay, first thing you ask yourself is, am I a $115 risk taker? Because you have unlimited upside potential, and you have defined your downside potential, and it is $115. The question is, are you a $115 risk taker? If you say, no, I'm not, I'm a $50 risk taker, then you're going to have to jump out here to a 212.50. So what you've done there is you have moved into a price range that you're acceptable. It is acceptable with you. You say, I can afford to lose 50 bucks. Moto's told me that when I play these things, my risk is defined. So if I do one contract and it's 46-cent bid, 49-cent ask, and I do it for 48 cents, and I got $48 in this trade, I'm willing to lose that. That's what you have to ask yourself. Okay, that's the first thing you ask yourself. Then the second thing you ask yourself is, what's the probability of it even working? Okay, well, in this particular case, you're paying 48 cents for a $212.50 strike. So theoretically, you need SPY at $212.50 plus the 50 cents roughly you're paying for that thing. You need that $213 for it to be a banner trade for you to really be able to say, wow, this thing's really working. So you're putting yourself in a position because of your risk tolerance of saying, okay, I'm buying an option that I need it to be at 213 to have a theoretic break even on this thing. And that would be if it went up 50 cents. I mean, no, let's see, we're at 211, $2.09. So you need to go up $2.09 to get to a theoretic break even. Well, then you're asking yourself, well, why does anybody play these? Well, there's reasons. If you'll go over to the last column on the left here, you got two columns I want to show you here. The one with the D on top here is your delta. The one with the T on top is your theta. Okay, the delta is a 0.282 on this particular play. What does that mean? That means if the stock or the underlying, whatever it is, goes up or down $1, your option is going to realize in a gain or a loss of 0.282, which is about 28 cents. Okay, so while theoretically, if it was getting close to expiration next Friday, if this thing had gone down or moved sideways, you're going to see that 50 cents. Even though it's cheap and you only got 50 bucks, you're going to see it decay. You're going to see it fade away on you because the trade is not going in your direction. Okay? So sideways and down, this thing's going to go against you. So keep in mind, you did one contract, you have $50 on the line. That's within your risk tolerance. That is the absolute most you can lose if this stock trades under $212.50 because it stays out of the money and that call will go worthless. That's what you're seeing happening here. The flip side is, how do you make money? Okay, well, we said it's got to go up $2.09 to get to your theoretic break even of your 48 cents plus your 212.50 strike, which is right under 213. If it goes up $1, you will see it realize, let's say you got in this today and tomorrow SPY went up $1. Okay? What you're going to see here is the T. I'm going to circle the T at the top of my page here. The T is your theta or your decay. Okay? And that particular theta or decay is 0.048 on this particular option. That's what that option will lose every single day that the market is open. Important on the phrase market is open. There's a lot of people that think they can sell options and capture theta over long weekends with holidays. That is not correct. Theta is determined or calculated based on open market trading days. So if you're one of those that says, hey, I'm going to sell that 212 call because we got Saturday and we got Sunday and we got Memorial Day, and that's 3 days at an 048, theta, so that thing automatically is going to open on Tuesday 15 cents lower no matter what happens. If it was that simple, the guys like Lloyd and I would be selling the heck out of this stuff and collecting all that premium. It doesn't work like that. That's 048 on a daily basis at the market's open. So let's say tomorrow, for some reason you bought this today and you paid 48 cents for it. Tomorrow the stock goes up $1, or SPY goes up $1. Okay, if it goes $1 up, you're going to lose the roughly 5 cents theta on it. So you're going to see your 48-cent premium go down to 43 cents. And we're going to use $1 for a round number to make it real simple. But you're going to see this delta of 28 cents come into your premium. So now you're going to have 43 cents plus 28 cents, which is what, 71 cents. So now all of a sudden you got an option that you bought for $48. That's worth $71 the next day. So in the perfect world, that worked really well for you. But it doesn't always work that perfectly because they move sideways or they go down on you. And those are the two things that hurt. So if it were to go, 50% gain, that's right. So you're like, well, this is cool. This works out really good. Why don't I go down here to the 214.51 and buy it for 10 cents and buy myself 5 contracts? Well, that's where your broker starts to come in. When we're talking about flat fees and per contract fees, that's where this stuff gets important. If it costs you $19 or $20 to do a 5 contract trade, you're not going to make any money on these out of the money options if you're doing 3 or 4 or 5 contracts. If you have interactive brokers, it costs you about $1. You can do it that way. Okay. So as you can see, I'm still on the tier 2 player, and we're still looking at buying calls and how they could potentially work. So let's say it does go up $1. Now all of a sudden your 48 bucks is worth $71. So if you're up 23 bucks. Well, if you paid 10 bucks in commission to get it, you're only up 13. If it costs you 10 to get out, you're only up 3 bucks. So you needed a 50% move in that stock option. You needed to go up 50 cents to make 3 bucks. That doesn't work. Right, exactly. Good job. How do you pronounce your name? Keat, K-I-E-T, Keaton. Exactly. If it went up tomorrow, you would see it go up 56 cents, and you'd be able to brag in the room if you made your entry, only if you made your entry. Say, hey guys, that post I made yesterday where I bought SPY 212.50 calls for 48 cents. The SPY went up $2, and those things are up 56 cents minus the 4 or 5 cent theta. They're up 51 cents. So I picked up 100% on that trade. Okay, that's a great trade when they work. Okay, let's take the other side of the coin. Let's say it moves sideways. Well, we know 5 cents worth of theta is coming right off the top tomorrow when the market opens. So now your 48 is worth 43. Let's say your SPY drops 50 cents, just 50 cents. Let's say it drops 50 cents. Well, half of that delta is coming off there now of 28, so there goes 14 more cents. So now all of a sudden your 48 cent lost 5 cents on the theta and 14 cents on the delta because the stock went down, or SPY went down only 50 cents, and you're like, geez, the thing only moved 50 cents, and I lost 50% of my option value already. You're going to lose 14 plus 5 is 19 cents. You're going to lose basically 19 or 20 cents. So while it's not quite 50%, it's close. And these are the option traders that are inexperienced, and they're going, wait a minute, I bought a 212.50 SPY call, and SPY went down 50 cents, and my stupid option lost 50% of its value. Well, that's because it's 100% of extrinsic value, meaning it's time decay value, and it's not worth anything to begin with. Okay, so that's the risk you're taking. And as you step out further, it compounds itself even worse on the downside. When you get one that really rocks for you, and it's not necessarily going to be SPY, you can really capitalize on that from the standpoint of being able to play the cheaper ones. And it happens. You can get a 9-cent one. You can go down to 214, probably not on SPY. All right, so what happened here? You're a guy that has a $50 risk, and you had to go out of the money to a 212.50 to stay within your risk tolerance, okay? So you're asking yourself, was there a better way for me to not take on the lower probability of success? In other words, you say, I can spend the 50 bucks, but my probability of success doesn't really take place until SPY doesn't move sideways or SPY doesn't go down and it only goes up, and I need it to go up by almost $1 or $2 to even make any money on it. So you're asking yourself, how do I offset that? What was the question? No, it changes every day. It's all, those are all what's called, they're all called theoretic values, and they change. The only one that will stay close to consistent is the theta, unless you get a big move one direction or the other. Okay, but those will stay pretty consistent, and they're all theoretic values that are relative to how the stock moves and what direction it moves. If you'll look, the closer you get to in the money, most at the money deltas are in the 48 to 52 range. They're always about a 50-cent delta, right at the money. Okay, and that's on stuff that's reasonably liquid. Okay, the delta is always 50%, but that doesn't mean you're going to be able to play the options. So if you look at my blue line, as I move it to at the money here, we get to that 50 delta. It's 48.9, so 49. It's a 0.49. So that's a 49-cent delta. 48.9, so 49. It's a 0.49. So that's a 49-cent delta. On a Friday, when you hear Lloyd or myself or any of us saying, hey, I'm going to play in the money the last couple hours because I want a 70 or 80 delta. Okay? If you'll notice here, on a 211 strike for next week, that thing has, there's two things you base it on. One of them is called intrinsic value, and the intrinsic, that's with an I-N-T, intrinsic value is true value. What is the true value of that option? In this case, a 211 call option has 0 intrinsic value because it's not in the money yet, so it's worthless from all standards. So as far as intrinsic value of your 211, it has no value. The flip side of that is what's called extrinsic. It's EXT with an E. The extrinsic value is the premium, the time value, the value that can go away and decay. This particular option at the money has 100% extrinsic value, meaning there's no real value. It's all premium. Because at $211, if it closed tomorrow at that, and this was the premium, that strike would be worthless. Even though it's close, it's still worthless. Well, at that point, you would see the entire thing go away. All right, so when you hear the guy say, hey, I'm going to play a 70 delta, or I'm going to play an 80 delta, if you'll look here, I'm going to move my bar up a little higher. So if you're playing at the money, a 211, you're playing a 50, we're going to make it real easy. You're playing a 50 delta, okay, a 50-cent delta. So at the money of 211, you're playing a 50-cent delta, and you've got $1.15 or $115 at risk of full extrinsic value of that premium. In other words, it carries no true value. When you hear these guys say, I'm going to play on a Friday afternoon, they don't want to see all that extrinsic value decay down to nothing in the last couple hours. Because this thing may still have 20 or 30 cents in it of extrinsic value and be trading right at 211. And if you play that one and that thing gets stuck and moves sideways or down, you're going to watch that premium decay really quickly on you because it's still all in extrinsic value and it holds no true value. Okay? So when you hear them say, I'm going to play an 80 delta, they're talking about going in the money. Okay? If you'll look at like a 207, let's look at a 207 and make the math a little easier. It's trading at $4.12 and $4.27, so it's got a mid price of about $4.20. Okay, a 207 call strike at $210.91. Let's use 211 for simpler purposes. Has $4 of intrinsic value. It's in the money by $4. Okay, so if it's in the money by $4 and you could buy the premium for $4.20, whatever it is, you only have 20 cents of extrinsic value. So in other words, your time value on that particular premium is only 20 cents. Whereas on the at the money 211, it was $1.15. So now what you've done is you put yourself in a position with a higher delta of that 85, 86 delta. That's what they're doing. They have a certain conviction on the direction of the stock, and they say, this thing is going to go up. But I don't want to position myself in a 211 strike that's all extrinsic value or time premium and watch myself be right on the call that I made, but the call itself, not call meaning the direction, but the call premiums themselves actually deflate. So you can be right and be wrong at the same time. So that's why when you see anybody in Lloyd or any of these guys say, hey, I'm going to start playing, 85 deltas, this is why they're doing it. Because that 85 delta at 207 has a true value of $4 and only 20 cents of extrinsic. So if they're right, they're going to get to capitalize on being right much quicker. Okay, you guys understand how that works? They're going to see if SPY moves 50 cents and you've got an 85-cent delta, your premium is going to move 30 cents or 35 cents. So, a 50-cent move for them is going to actually capitalize for them on about 35 cents. That's how they're going to make their money, by moving into an in-the-money strike. So you'll see Leonard post that also. You'll see Leonard say, I don't see what the other mods do, but you'll say Leonard say, last couple hours he's going to say, hey, I'm going to play in-the-money strike on such and such. That's why they're doing that. They want to reduce the extrinsic or decay value in the premium and have more true value of that premium or intrinsic value. So they're willing to move in closer if they have a strong conviction on direction. Obviously, if you're wrong, it's going to bite a little harder because you're playing on an 85-cent delta. So if you don't have any conviction, you're just doing it on a whim, don't be so quick to jump into those in the money ones, because they're going to hurt if you're wrong. All right, we on track so far? Y'all understanding this stuff? Uh-oh, everybody went to sleep. I guess everybody's just counting on watching the video later. I just talked to my... Okay, you guys understanding this? Okay, what I'm trying to do is address terms that you guys see in the room. And in any room. I don't care whose room it is. No, actually, it's my vape pipe. I'm fixing to hit it. Gamma is a theoretic percentage. Most people think it's a dollar value. That's a percentage, but it's close enough to use it as a dollar value. So if we go back to, let's go back to the 211. Okay, it has the 211 strike has an 06 theta. That's your daily. That's going to decay. Has a 489, so basically a 49-cent delta. The second column. Hang on a minute. I gotta get a drink. Give me one. All right. Sorry about that. I have to look up because I got a big monitor that all this stuff's on. When I look up, I put a stress on my throat dries out when I talk so doggone much. The gamma is essentially a percentage or a value that's going to be added to that delta on the second dollar move. So on the first $1 move in the underlying, it's going to realize 49 cents. If you look at the blue line, that's going to be added to the premium if SPY goes up $1. If it goes up $2, the second dollar is going to realize roughly 61 or 62 cents. It's going to add that gamma to the delta, and it's theoretically a percentage, but it's close enough that you can just, the stuff moves so fast you're not going to catch it anyway and say, oh, I thought it was going to add 13 cents, it added 12. Okay, but theoretically your second dollar move is going to realize 61 cents in your option. So like I said, on your at the monies, the premiums are high, a lot of extrinsic value. However, if the thing goes the direction and your conviction is right, dollar move is going to get you 49 cents in the first one, and the second dollar move is going to get you 48, 50, 61, 62 cents on the second dollar. So now all of a sudden you're up about $1 or something, and you've doubled that one. But that stuff's got to go right for you. It's got to go in the right direction to get a double. You need SPY. If you're in that SPY call 211, you need it. If your ambitions are to double that premium, you need it to go up $2 or better tomorrow to get that, because otherwise all that stuff's working against you. Your theta's getting taken out of there. If it dips at all, it could drop 50 cents in the underlying, and 49 cents. Half of that would be 25 cents, all of a sudden your $1.15 premium is only worth 85 cents. And you're like, geez, the thing took a 40% haircut in 2 minutes. That's the downside. So yeah, for face value, if it went up $2 tomorrow and you were in those today, you'd be near a double. That'd be great. But let's see, we also determined that you're a $50 player, so you wouldn't be playing here anyway. So how can you play here? All right, that's where the spread trading comes in. Let's say you're still, there's a couple ways to play spreads, okay? There's a lot of different types of spreads, essentially an iron condor is spreads, it's two credit spreads that you're doing, one on the put side, one on the call side. A butterfly is a spread. You're selling a couple short legs, you're buying two long legs. All these other ones that you see a lot of people talking are on your broker's platform are probably going to be what's called vertical spread, like a vertical call spread, something like that. It'll be on there. I enter mine all manually, so I don't use IB. I don't know what they call them. So now you're saying, okay, for me to play a 50-cent premium, I've got to play at 212, which puts me $1.50 out of the money. How can I do better than that? Okay. When you start seeing in the room the assignment, I'm not reading much on the room, so I'm going to either do one or two things. I'm going to let somebody else answer your questions so I don't get sidetracked here, or we'll answer all these questions at the end here. You get assigned, you get exercised if they're in the money. So if you've sold a 211 you bought a 211 a call and it's trading at $212 and you did 10 contracts, and your premiums are worth $2 and you bought them for $1.15, you're going to get those shares. You're going to get that exercise to you. You're going to get a $211 trading vehicle that you bought 1,000 shares of if you did 10 contracts. You better be prepared for that. So like I said earlier when I started, play them for the premiums. Don't play them for the exercise. At expiration, if it's in the money and you've made your money, or even if you've lost money, get yourself out of the option, sell the option, get yourself released from the commitment that goes from the right with no obligation to do it to an obligation when it goes in the money. All right, so see, now I got sidetracked. Okay, so now you're asking yourself, okay, how can I play this thing like the room is talking about where they're doing a spread? So let's say you're still bullish, okay? There's a couple different ways to play these vertical spreads. Let's say you're still bullish on SPY. You've already determined that. And let's say your range is 50 cents. Typically, if the options are liquid, like they are on Apple or SPY or QQs, whatever you're playing, stuff like that, the options are fairly liquid. They are spreading them out a little bit more than they used to. They used to be a penny or two, and you could get in and out easily. Now they're 5, 10 cents. As you move away, you're going to see, go deeper in the money. They're going to start to go up to about 15 cents, 20 cents. Gets a little tougher. They spread them out a little bit more. So let's say you want to still be bullish on this thing. You're going to do what's called a debit spread. Okay? Anytime you see the word debit and spread associated, that means you're still paying for it. Okay? When you see anybody post in the room that they're doing a credit spread, then they're collecting the money and they're being the one paid. Okay? So let me show you how you would structure a debit spread on SPY. And if we do it at the money, typically it will give you about when you see someone post in the room, hey, I'm going to do SPY debit spread for next week Friday expiration. I want a 1-to-1 risk reward or a 50 cent to $1 risk reward. Okay, so if we were to use the 211 strike and the 212, okay, we use the 211 and the 212. That is $1 difference between the two strikes, which means you have a $1 max to make on that thing. Okay, the 211 is $1, going to cost you $1.15. It's got a bid of 113, an ask of 118, so you're going to be able to fill that for about $1.15. And the 212, you would actually, that would be what's called your long leg, and in a debit spread, you're going to sell a leg. Okay. You're going to sell a leg, and in this case, if you wanted a $1 spread, you would sell a 212, and it would bring you back 67 cents. So somebody do the math for me. If I bought a 211 leg for $1.15 and I sold the 212 leg for 67 cents, what's my debit cost? So take the one you guys, I told you I was making y'all do a little bit of work here, 48 cents. Okay, so what did that do for you now? Okay, thank you very much, Keith. You're still bullish on SPY. Okay, you bought a 211 long call. That's your long leg. Okay, you sold a 212 call. That's your short leg. That's where you have to have the three trading. You now have a short leg sold. Okay, what did that do for you? You got a 48-cent debit on that. That's what that cost you. So what happened here? It allowed you to be able to play basically at the money for the same 48 cents it was going to cost you to have to start playing at $212.50. So you don't need SPY to get to $212.50 to make your 48-cent call work anymore. Now you're playing at 211 on SPY and you're paying the same 48 cents. Okay, so what did that do for you? Well, if your conviction is still bullish and you think, well, I think SPY is going to go up, well, it allowed you to play right at the money for the same price as what you had to pay to start out at $212.50. You bought a debit spread. You bought the 211, you bought the 212, or sold the 212, and it cost you a 48-cent debit. How does that work? Okay, if you're wrong, and let's say SPY closes next Friday at $210, okay? Both of those call contracts, the 211 and the 212, will be worthless. They will be out of the money. So what was your maximum risk? It's per contract, the 48-cent debit that you paid plus your commissions. In our case with IB, we pay $1 for a trade like that. In your case, you might pay $10. But aside from commissions, your risk, I want you to understand, is fully defined. If you do what's called a debit spread on SPY for next Friday, 211, 212, and you pay 48 cents for that, that's the absolute most you can lose if this thing goes under $211. You're risking $48 per contract. If you do 10, you're risking $480. Okay? What's the flip side? So you're saying, okay, Moto, why wouldn't I do that? Well, in most cases you would, but there is a price you're paying to be able to start at $211 versus $212.50. What's the price? It has a cap on it, or a ceiling. What you've done by selling a short leg is you have capped yourself off at that 212 leg, the short leg. So that is the dollar spread. That is the absolute most this can make, which is the dollar minus your 48-cent debit or 52 cents. So when you see someone in the room talking, hey, I want to trade something with a 1-to-1 risk reward, that's a 1-to-1 risk reward. You're risking 48 cents to make 52 cents. That's close to a 1-to-1 reward. You see someone post in the room, I want to trade something that has a 50-50 risk reward. That's what they're talking about. They want to pay 50 cents to make 50 cents. So the reward part of it, you're getting to start right at the money. You get to start at a $211 price and it's trading at $210.91. So if you're right, you're starting right at the money. That's the first reward. What's the second reward? The second reward is you're basically selling a leg that will stay connected to your leg and basically serve as insurance in the event that you're wrong. Okay? It's going to capture part of the problem with you versus owning just the 211 strike call. If the thing were to go against you and drop $1, you know, you're going to see 50 or a 0.489 delta come out of that 211 strike. So basically you're going to lose 50 cents off your premium if you're wrong. Well, in this particular case, if you have the spread on, you're going to lose the 0.489 delta, but that 212 is going to also lose on its 0.35 delta, which is a difference of 13 cents. So what happens here? So tomorrow, say you bought this spread for 211, 212, and you were wrong, and it dropped to 205, 210, whatever, anything under 211. Well, the short leg captured some of the problem for you. I'm trying to put it in real specific, easy terms to understand. So you didn't have to realize the entire 48 or 49 cent loss on your premium because it was offset with the short leg that you sold that has a 35 delta. So your only realized loss there is going to be the 13-cent difference between the two. So there's the second advantage is you got to play right at the money. If you were wrong, you got to have a short leg that absorbed some of the problem rather than taking the brunt of the whole problem by yourself on a long 211 call, just a long call by itself. So you basically insured yourself to have another strike or another short leg, which someone else has, to endure some of the pain by being wrong, okay? So how are you right on it? Well, let's say next Friday it's trading at $212.50. Well, now both of your strikes are in the money, okay? So if they're in the money, that means both of those are going to be worth the full dollar value. The 212's in the money, and your 211 is now worth the full dollar all the way to the 212. And if it's trading at 212.50, then they're both in the money. So you're going to realize the full value of that trade, which is $1. So you will see your 52-cent reward on that thing. Right, you made 52 bucks a contract, and theoretically, if you do the math, that was 100% win for you. If you had 48 cents in it and you made 52 cents, you had 100% win on that trade. So, in a nutshell, where do you benefit from a credit spread? You get to play at the money. If you're right on a 50-50 trade or a 1-to-1 risk-reward ratio, you're going to get 100% on a win on your thing. You're going to distribute some of the potential loss or the potential risk of it being wrong against another leg that's conjunctive to yours, to where you guys are tied together, and you don't have to take the whole loss all by yourself right away. You only see 13 cents come out of that thing if the SPY drops $1 versus 50 cents if you're a long call player. The only downside, like I said, you have a cap, you have a ceiling. Anything above $212, you're not going to get to realize. If SPY goes to 215 bucks, the guy that owns the long 211 call is going to be woohooing in the room. You're going to just be saying, well, okay, I got to make my 52 cents a contract or 52 bucks, but I missed out on $3 above it. Well, okay. When you weigh risk against reward, look at how SPY moves. Look at what it really does. If it was that simple, everybody would be playing long calls. It's not that simple. The spread positions you much better to profit by having the spread on versus the call. You're not getting beat up with that delta so hard. Now, you guys catching this? I'm trying to make it as easy as I can here so that you guys understand it and understand the difference between why you would want to play a debit spread versus just playing the long calls, and why it would be in your best interest to get yourself approved for spread trading and be able to sell that short leg, because now you can walk away and say, well, that made a whole lot of sense. That's how I want to play. I want to play at the money. I want to be able to take 100% win if I'm right, and I want to start where it's trading at, and I don't care if I have a cap, because 100% is 100%. If you want to make 100% on $200, then buy 4 contracts. Play more contracts. Make your same 100%. All right. Now, let's assume let's see, if you have a 211-2 spread and stock is at 212, then that means it's 100%. Most you can make is 100. Well, you're going to make the full $1. The difference between the two strikes. The 211 to the 212 is a clean $1. So no matter what you have as a debit, the most you can make is $1. So a lot of guys will try to leg into a trade like that. When you see someone in the room say, hey, I legged into a bull call debit spread, a 211, 212, I legged into it, what they're going to try to do, and most brokers are going to require you to buy your long leg first. They're not going to let you sell your short leg first, the 212 leg, because then you're selling a naked short. So to leg yourself into a spread, and you can put these spreads on as one trade with your broker. You just enter it as one trade. You're buying the 211, you're selling the 212. Their platforms will recognize what you're doing. Some guys like to leg into them to obtain a better debit. Someone like myself or Lloyd or some of these other guys in this room that are better, more experienced traders with more, better understanding how things work, we would try to leg into that trade. Obviously, we could do the short leg because we're approved for Tier 4 options. Most of you guys in here are not, so your broker's not going to let you sell that short 212 leg first. They're going to require you to buy the 211. And if you're any good at reading charts, quick charts, 1 minute charts, tick charts, whatever, you may be able to theoretically leg into these trades with a better debit than the 48 cents. You may buy your long one, and then the stock may go up or down one direction or the other, and you'll get a better price on your short one, okay? And by doing that, you're legging into the trade. But check to make sure that your broker's not going to smack you for 2 commissions, okay? Because they might. In our case, our commissions are so cheap at $1 with Interactive Broker that if I could buy the 211 for $1.15 and then sit on it and wait till that 212 gets to about 80 cents, then I've only got a 30-something cent debit in this thing, whereas you got a 48-cent debit. For you to leg in it twice, they're going to charge you 2 commissions. Whereas for me, I pay $1 in commission. I can leg in it to get myself a $15 better price on the debit, especially if I'm going to do 8 or 10 contracts, and they only charge me $1 or $2 for commissions. No. A mental stop, right? Not a physical stop. Yeah. All right, so you guys understand, you should understand a long call play and a long bullish debit call spread. You'll see it called a bull call debit spread. That's what this is, okay? Now, you would do, I don't want to bury ourselves on the other side. You would do the exact same thing on the put side if you were bearish, okay? If you're bearish and you think the thing's going to go down, then you would go over here and you would say, okay, I think it's going to, close at $208. Say you're bearish and you think it's going to do $208 by the next Friday. You would do the exact same thing on the put side. You would say, okay, I want to do a put debit, a bearish debit vertical spread. You would then buy like the 211 at $1.25, and you would sell the 210 and do a debit spread there also. You would sell the 210 for 89 cents. So you got 125 from 89 cents is about the same 40-something cents, 40 cents. So what do you have going here? Well, now you're playing it bearish. You're doing the exact same thing, but you're playing it bearish. You're saying, I think SPY is going to close under 210 by next Friday. And because that's how I think, I'm going to do a put debit spread. I'm going to buy the 211 and I'm going to sell the 210. And I'm going to pay 46 cents or whatever it is for that. And if it closes under the 210, then both of those strikes will be in the money, and I will realize the exact same dollar, playing it on the call on the put side as being bearish. So it works exactly the same. So you can play it both directions from a debit spread standpoint. You can play a bull call debit when you want it to go up. You can play a bear put debit when you want it to go down. All right. Any question? Yeah, it works identical on the same. And you can price them both out, and they're usually priced pretty close to each other. It depends on how close the strike is to the actual trading price. In this particular case, because the 210.91 it's trading at, that 211, 210 put spread on the other side is going to cost a little bit more because it's actually in the money a little bit. That 211 strikes in the money by 10 cents, and on the call side, it's not in the money. You're playing 2 strikes that are out of the money. So to play it on the put side is going to be a little more expensive. All right, so what do we got here? What happens to spread? Let it open. Cash to close. Money. Yes. Okay. All right. Now, the other term you hear in the room. Okay, you guys understand debit spreads? That all makes sense to you? We good to go on that? And you can do this on anything. You can, the key to success with these trades is that the options are liquid. Okay? If they've got them spread out, here's what you don't want. Here's what you do not. I don't like, my mom used to get mad when I use the word don't. Here's what you do not want. You don't want to play a stock that has a $1 max that you can make on it, and you're going to have to pay 60 cents to get in, and it's got 20 cents on the spread. Because if you got a dollar max and you paid, even if your conviction's right, if they're spread out real far because there's no liquidity in the options, if you're a dollar max and you pay a 60-cent debit and you have a 40 cents at risk and there's 20 cents of premium, I mean spread on the strikes, how are you going to make any money? You're not. Unless they just go, even if they go in the money, and you'll see this at the end of the trading day on Friday, you'll be fighting that thing to try to make 20 cents off it because they will keep that spread there, and your max gain is only $1 40 cents to begin with when you got a dollar minus the 60 cents you paid. So you only have a 40-cent max profit anyway, and 30 minutes before the end of the close on Friday of expiration, you're going to be sitting there looking at that going, why can I not even make 20 cents on this thing? Well, that's why. The options are not liquid. So try to stay away from those on spreads that aren't liquid because of that. Liquidity for spread, right. Cover it. Look at, it kills your profits, especially if you got to pay 10 bucks in and 10 bucks out. If you do one contract and it costs you 60 bucks and it's got a 40 max profit on a $1 strike spread and it's got a 20-cent spread on the bid ask and you pay $10 to get in and 10 to get out, you probably need to go find something else to do because you have no way to make money on that trade. All right, let's talk about credit spreads. Okay? A credit spread. A credit spread, you're going to get paid. Okay? You're going to do the exact opposite of what I just spent the last 30, 40 minutes talking about. Okay, let's say you decide I'm bearish on SPY. I don't think SPY is going to go up. So let's say that's your conviction, and you say, I don't think SPY is going to go above this 211. Okay, I just don't think it's going to happen. Well, you can still trade at the money for about a 50-cent risk reward. But in this case, here's what you'd want to do. I'm going to take the blue line off the put side so as not to confuse you guys. Look over here on the call side again. I'm going to click on the 211. Let's say you decide and say, there is no way that by next Friday, SPY is going to be above 211. Just no way. Not going to happen. It's going to be 208. Say you're one of those that posts in the room that you're so certain about things and say, oh, SPY is going to be at 208 next Friday. And I get a kick out of people when I see that. When they're wrong, they're usually really quiet. But let's say you looked at your charts, you've done your technical analysis, and you say, based on this support and resistance, blah, 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 there's absolutely no way that SPY can be above 211 by next Friday. So you're going to want to do a credit spread. So what you're going to do in this case is you're going to sell the 211 strike. Okay? It's traded at 210.91. That's out of the money. You're saying, I'm going to sell the 211. So in this case, you're going to collect the $1.15, and you're going to buy the 212. Why? Because in this case, because you're the premium seller, the cap that was put on the premium buyer that he's scratching his head when it went up 3 extra bucks and went to 215, he's going, man, I missed out on that 3 bucks. Well, as the spread seller, when you're selling a credit spread, you're going to scratch the other side of your head and say, wow, am I glad that I did a credit spread with a cap on it or a ceiling at 212, because I didn't have to take on the pain that was associated with that other 3 bucks. So in essence, what's happening here is you're capping the problem. You're putting a ceiling on the problem. So at the 211, 212, if you sell that as a credit spread, if it closes under 211 by next Friday, let's say you collect the 52 cents, you're on the other side of it. The debit spread seller or buyer paid 48 cents, and there's a 52-cent credit on the flip side of that for his profit. Let's say you're the credit spread seller. You're the other one on the other side of that selling it. So you're selling and putting the 52 cents in your pocket. Okay? You sold a 211 and you bought a 212. Okay? The 212 in this setup is the cap that actually saves you from not losing more than almost 100%. Because if this thing closes at 215, you're going to be glad that you capped that credit spread off at 212 and only could have the max pain of $1. Okay? $1 minus your 52-cent credit, you're going to lose 48 cents. Again, with a credit spread, you have defined your risk. That's the important thing here. With this credit spread, even with a 211, 212, you've defined your risk. You collected 52 cents on a credit. If it closes below the 211, both those strikes go worthless and you keep your 52 cents. Okay? If it closes above 212, the trade will be in the money on both of them and you will realize the max loss on that trade, which is the 48 cents. But again, your risk is 100% defined to the 48 cents per contract, or 48 bucks. That's the most you can lose, is the 48 cents. Okay. Most of the time, there's a lot of spread trading that goes on. Okay? There's a ton of spread trading that goes on. Normally, I'm not going to say all the time because it's happened to me. It has a lot to do with liquidity. Okay? If you play one, I played a deep in the money GLD, the gold GLD, and I was one of the only ones playing the thing. But I was one of the only ones playing the thing. But I was right. So I'm okay with that. I don't mind being a lone ranger if everybody else is off playing their little stuff, and I make my own trades. I don't mind being a lone ranger. However, the liquidity was so low in the options, and because I played them in the money, they assigned me 1,000 shares of the stupid thing a couple years ago. So you take that risk. At the money trades, to answer your question, you're normally probably not going to get an assignment on the short leg. There's so much of this going on that it would put the screeching halt and throw the brakes on to all the retail traders being able to trade these types of spread trades if you got it assigned to you all the time on the short leg. It just doesn't happen. Where it happens the most is when you go to one of the next couple options I'm going to show you on credit spreads. Okay? You'll see where it could potentially happen there, and it happens to me all the time. Right, the long leg offsets the short leg, but as soon as you go in the money, and if you go deep enough in the money, you've given up that same right on that short leg to have that assigned. Even if you were to when you naked sell it, you give up the right, but even in a spread that you go deep in the money, you still theoretically have given up your right on that particular leg. On your long leg, you will always have the right up until expiration to actually decide if you want to buy the stock or have it exercised to you. You always have that right, and that doesn't go away until expiration. However, in a spread trade that goes you're deep in the money, you do take the risk on of having that short leg assigned, because you have said, if you will pay me X amount of dollars, I will sell you these. And you don't get to make the decision anymore. So in the full answer to your question, in your at the money stuff, not likely to get assigned. Out of the money stuff, we can't get assigned. Deep in the money stuff, which is the stuff I like to play, you do get assigned. Oh, not a lot. They tell me it's random, but for some reason I happen to be the most random selection that I think anybody out there could ever have, because they randomly stick it to me all the time with them. So I'm not sold it's random. Yeah, exactly, Lloyd. I've called them 3 or 4 times. I don't call them anymore because I don't care about the assignments. But when it first started getting assigned on in the monies, I called them 2 or 3 times. I said, yo, I'm not buying this crap. The first time I did, the guy went through his big explanation how the exchange, puts out the request, and then the request hits all the brokers, and then the brokers find a client that has an account that it can handle, and it goes through this big process of a random computer selection, and boom, sorry, you happen to be the poor soul that got selected. I was okay with that. I bought that a while back. When it happened the second time, a week later, I was like, no, this isn't random. This is part of the process when you play in the money, deep in the money stuff. So when I called him back, he tried to sell me a second time that it was still random. And then when I got signed again, a third time, I called him and told him it was full of crap. I said, there's nothing random about this. So why don't you guys just tell me, if you're going to play deep in the money, you're probably going to get an assignment. Okay? So you guys that are asking, what's he talking about? Account, exactly. If they see your account can handle it, they will assign you. But, you know, they're not going to assign you if it's going to cause you a major problem, uh, and the whole thing's going to go on margin and blah blah blah. And your next door neighbor has an account big enough to take the assignment. They're not going to flip a coin and stick you with it. They're going to give it to him because he's got the money. Right. Okay. So what's your next option? So let's say you think, okay, I want to do a credit spread. I want to increase my probability of success a little bit. But the flip side of that coin is I'm willing to take a little less money, but a little more reward. I'm trying to talk and read what y'all are saying here. Right, random broker, random account. That's such bull. They try to tell us that too. All right, so let's look at it. Let's go out a little ways. Let's go to a 213. All right. So what's the trade-off on this one? Let's say you still say, I'm still bearish on SPY. I still think it's going to go down, but I don't want to play the 50-50 game, 1-to-1 risk reward. I want to be paid. I'm willing to be paid a little bit less, take on a little more risk, but have the probability of success on the trade fall heavier into my favor. So how would I do that? What you can do is you can go out here to like a 213, and you can say, okay, if I sell the 213 for 33 cents, and I buy the 214 for 15 cents, now I'm only getting paid 18 cents. Okay, so you're gonna sell the 213 on the call side, you're gonna buy the 214 on the call side, and now you have still created yourself a credit spread. You're going to sell the 213 for 33, buy the 214 for 15. You have what I said was 18 cents. So what have you done here now? Now what you've done is you've taken on an 18-cent credit. I think these are the kind Lloyd likes. Okay, and everybody has certain stuff they like to do that they feel comfortable with, and that's all that matters. What he likes to do, if it works for him, great. And what I like to do, if it works for me, great. Whatever you want to do your own thing. I'm going to show you the three different types. I've already showed you the first one at the money with the 50-50, risk reward of 1-to-1. I'm going to show you the other two types, and then you try them, maybe paper trade them, and say, I like this one. This is my style, okay? And I just know from being around Lloyd for so many years that this is his style. He wants to sell, and I'm saying this, I'm not speaking for him, but this is how he did his one out to May and June on SPY. He's going to sell a 213. He has a 212, I believe a 212, 214, and a 214, 216. SPY sold, credit spread sold out to May and June, end of May and end of June. This is that type of trade. This one you collect 18 cents. I can do that. Yes, I can do that. This one, I actually have that on here. I'll have to spread it out a little further. I got that on here. What he's saying is a lot of people will look at probability of success or percentage of it. It's probability of in the money, or you can have probability of out of the money, or basically you can look at the probability of it working is what it boils down to. And in this particular case, let's go through the 213. Okay? On the 213 strike here, if this is your credit spread, you're selling the 213, you're buying the 214, you have $1 at risk max. You're still good for the 213 to 214 difference, which is $1. You collected 18 cents, okay? So if you did 10 contracts, you're collecting $180, and your max loss is the $1. So what's your risk? Somebody posted, I keep forgetting, I told you guys I was going to make you participate in this. If we do a 213, 214 credit spread, and we sell that, and we collect 18 cents, and we do 10 contracts, and we risk, we collect $180, what's our risk? JD nailed it there. No, oh, I had to do my own math. Daryl nailed it there, 82 cents. $1 minus 18 is 82 cents. You were close. We'll give you the benefit of the doubt as a typo on that one, JD. You were on the right track. So on 10 contracts on this particular one, our risk is $820 on 10 contracts to collect $180. Well, one of the features on your columns here, and if you go up to on Thinkorswim on the Layout tab, you can right-click on that or click on it and go on down to Customize. And in that list on your Customize, it's going to give you a couple things. One of them called probability in the money and probability out of the money. They're just vice versa of each other is all they are. And all they are is the difference between the dollar and the delta. So if you'll look at our 213 strike here, we are risking, and I'm saying 10 contracts just to make it easy, we're risking collecting 180 bucks, and we're risking 180, and we're risking 820. So how could all that play out? Well, we've given ourselves a better probability of success, okay? And how did we do that? We went out to a 213 strike. So now all we needed to do is we need SPY to close under 213 for us to keep this credit. So we pushed ourselves out to a 213 from the 211 we were playing at the money for a 50-50 chance. Now we pushed ourselves out to a 213. So if it stays under $213, we keep that 180 bucks or 18-cent credit. I show it on my Thinkorswim here. I have what's called probability of it. I don't remember if it's probability. Yeah, probability of it basically working. I'm gonna make it in simple terms, not in the money, out of the money. Probability of success. And as you'll see on this one, it's 78.51%. These are calculations that are done by the platform to give you an idea of what the chances are or the probability of that strike actually going in the money. And in this case, it's 78.51% chance that it does not go in the money. Okay, you guys see that number? I'm circling it right here. It's that 78.51%. So this trade, you're looking at it, it's okay, it's got an 18-cent credit. I'm risking 180 bucks. I potentially could lose 820 bucks. But my Thinkorswim platform is saying this thing has a 78.51% chance that SPY does not go to $213. And if you'll notice, if you take $1 minus that amount, that's equal to the delta. A lot of people, if you listen to them, they'll start discussing delta probabilities or the probability of something happening based on the delta. That's all they're talking about. This thing's saying it has a 0.219 delta. This has a 22% chance of going in the money based on the delta. It has a 78.51, which is the dollar minus that, has a 78.51% chance of not getting there. So it's just vice versa. So there's a lot of people that will like this type trade better. They'll say, okay, if I add that to my 214, which is an 88.42%, you know, the split in between them is an 84%. So I've got a long leg and I've got a short leg. What's the chances of this thing hitting right in the middle and costing me 50 cents because it closes at 213.50 and I got paid 18 cents, so I would lose 32 cents. It has an 84.02% chance of that not happening. Okay, so what happens here, you moved out a little bit, you're still doing a credit spread, you're getting paid a little less, you're taking on a little more risk, but you're also giving yourself a higher probability of success that it stays out of the money on that. And in this case, the center point is, which would be the middle of this thing, is an 84.02% chance that it will not go in the money. So a lot of people, you'll read, a lot of people are successful with selling credit spreads. They all have their little zone or range where they're comfortable. Many of them are comfortable in this 85. A lot of people sell naked calls and puts and stuff. The ones that do are capturing that premium, and they're making, yes, Karen at Super Trader. Karen Super Trader from Tasty Trade nails it. She sells them naked. Does a lot of credit spreads. Her, if I remember right, I think hers is 85. She feels comfortable selling a credit spread that has an 85% probability of being successful. And this is where you guys can do that same thing and mimic what someone like her is doing or what other credit spread traders are doing, and play on an 84% probability that you're right, that it's going to work, that you're right, that's going to work for you. Okay? You can play around with that. Some people are comfortable around 70%. Some of them are just flat out not comfortable unless they're up in the 90%. They want a 90% chance they're going to be successful. Well, the flip side is you get paid less and you take on a lot more risk. So if you're playing a 215, 216 and you're getting paid 4 cents, you have a 96.79% chance you're going to win and a 3.3% chance that you're not going to win. So the probability is way in your favor. However, the risk is miserable. You're getting paid 3 or 4 cents and risking it on a dollar. So on 10 contracts, you're getting paid $30 to risk 970. So I'll tell you quickly, I'm not going to play in the 96% probability range myself because I'm not going to risk making $40 to potentially lose 970 or $60 if someone says something, Draghi or whoever, and all of a sudden SPY jumps $5. Right, after the fees is not even worth it. So, and these are things you're going to see also. You're going to see it in other rooms and in this room. You're going to see someone say, "Hey, I'm doing a credit spread on SPY for with a 20 delta." If that's all they're willing to tell you, they're usually some smart Joe Blow that thinks he's above and ahead of everybody else in life. You guys can now say, "Oh, okay, so you're an 80% spread trader. Okay, good. You like the 80% probability of it not going into money, so you got a 20% chance of getting bit." So you can all of a sudden start looking like some kind of hero, and he's going to step back and go, "How does this dude figure that all out?" So a lot of them like to use the short version rather than have you understand what the heck they're doing. So they'll say, "Hey, I'm going to do a 20 delta on a SPY credit spread." Okay, well, all they're saying is, "I'm going to play a SPY credit spread. I'm going to put probability in my favor by 80%. I'm going to take a less credit amount, and I'm going to take on a higher risk because the probability is good." That's all that's going on there. All right, so I've showed you at the money. I've showed you out of the money. I'm going to show you one more. 55 days. Yes, she usually runs 45 to 55 days. Oh, I know there's another room. I know these guys hang out on Twitter and what's that stupid thing? StockTwit. You guys can come if you pay attention. If you don't get it all tonight, rewatch the video webinar. If you pay attention, you guys can actually be a whole lot smarter than most of those guys in there if you take this stuff to heart and learn it. All right, let's go to an in the money. My kind. All right, let's look at an in the money credit spread. Let's see. There's no other room. StockTwits, bunch of idiots. All right, let's look at an in the money. All right, let's say you're just convinced that this market is going to die. It's bubbled up, it's overpriced, it's over this, over that, it's going to die. You're convinced. All right? So let's go where my blue line is and start with a 207, 208. We're trading at 211. And you looked at your charts. You looked at this time frame a year ago, 3 years ago, 5 years ago, and historically in May, sell in May always worked. I'm just saying it theoretically. It hasn't worked for a couple of years. They stopped making that easy for us also. But let's just say everything you've looked at tells you SPY is going to be under 207 by next Friday. Well, you then become an in-the-money credit spread trader. All right, so you sell the 207. All right, and it's 412 bid, 427 ask. Somebody do the math for me real quick. What are we going to be able to sell that for? What's the mid price on that? Quick. See who's on the ball here. What's the mid on that? 420. Thank you, Daryl. All right, so you're going to sell a 207 call, and you're going to buy a 208. Why are you going to buy the 208? Well, you want the same protection. You want to have a maximum of $1 on this trade that you can lose, especially if you're wrong. You're starting in the money, and it's already trading at $211, and you're selling a 207, buying a 208. So technically, you're already wrong. You need it to move for the trade to work because you're already wrong to start with, as far as being in the money. But you get paid a lot better. You'll see why. So somebody give me the difference of 327 from 335 on the 208 strike. Daryl will get this for me. He must be the only one awake. Okay. All right, so take $4.20, which is what we're going to sell the 207 for, and deduct $3.31 from it, which is what we're going to buy the 208 for. And somebody give me how much my credit is. There we go. Thank you. All right. We have an 89-cent credit if we sell a 207, 208 credit spread. How's that going to work? Okay. We're getting paid 89 cents. Let's say we do 10 contracts again. We're going to collect $890. What's our risk? Somebody answer that. Come on, Keith, beat him to it. Boom. Daryl knows this stuff. Your risk is 11 cents. Okay, so on this trade, you still have the dollar spread between the two strikes. You're collecting an 89-cent credit, and the maximum risk is 11 cents, so 110 bucks. That's the absolute most you can lose on this credit spread trade per contract. How do you lose it? If SPY stays above 208. If it stays above 208, both your 207s and 208s will be in the money, and that credit spread will be worth the full $1. Interesting enough, if you watch it, it'll actually go higher than what the max loss can be all the way up to the end of Friday. You'll be going, wait a minute, how can this thing be worth $1.04 or $1.07 when the theoretical maximum loss on it is $1? Well, that's because of the spreads. If you look at the spreads, they've got a 20-something cents or 20-cent spread on that thing. So while if you let it go through expiration, in my case, Interactive Brokers would wash that trade. Most I would see is they would, assign one, exercise the other. The most I would see would be the $1.10. I mean, the 11 cents, $110. So that's the most the trade could cost me. I keep my 89 cents. If SPY goes under 207 by next Friday, then those 207, 208 calls both go worthless. So what happens here? All right, we went in the money. We get a lot better reward, 89 cents. We have a much lower risk, 11 cents, but we have a much lower probability of success also. And if you look at it on here, now we're in the 11.17 range. Actually, wait a minute, 207. Now we're in the 15.47 and the 21 with a center of about 18. So you only have an 18% chance that you're going to be successful on this trade. Okay? So you only have 18%. It's still capped at $1. The most you can lose is the dollar. In this case, it's going to be 11 cents or 110 bucks on 10 contracts. But you can profit $890 if this thing closes under $207, the SPY. And your probability of that happening is only 15%. I kind of like these kind of trades because you get paid well and you take on low risk if you have strong conviction about something. And there's guys in here like myself that have strong conviction about certain things. And in this particular case, if my strong conviction was that I felt like SPY was going to be under 207, and I had multiple reasons why, I would love to take on a trade that, a trade that pays me 89 cents with only $110 at risk or 11 cents. If I've done all my homework and I feel like, hey, I'll take that 15% because I feel 100% the thing's going to work, and I may have all my reasons. Yeah. All right, Governor. Thanks for help. You're throwing your comments and stuff around. I appreciate the help. All right, so you understand it in the money one here. Has to go under 207 for this to win, or I'm looking at the time here. I don't want to get too. I refuse to do more than 2 hours on these. We're only an hour and a half. We're at an hour and a half. That's long. All right, so we got a higher reward, lower risk, but lower probability of success. But this is an in-the-money credit spread. This is the kind you have to be a little careful on. If you're selling a 207 strike call, that's $4 in the money, you're giving the right of exercise to someone else. You're saying, hey, I'm doing a spread, I get that, and you're telling your broker, do me a vertical call spread, credit spread, pay me the credit, the 89 cents, and I'm going to risk the 11. However, you did release your authority over that 207 short strike. And with it deep in the money, you take a big potential that could get assigned on you. Okay? because you've given up the right to decide what happens with it by selling it. So the out of the monies, they're not in the money, so there's nothing to sell you. The at the monies, they don't assign you because nobody could play spreads. The in the monies, like this one, you take on the risk that you're saying, hey, I'll challenge you. I'll sell you one that's $4 in the money. You take on the risk of it being assigned to you, regardless of what you're trading, whether it's UVXY, Micron MU, Netflix, any of those. You put yourself out there as a random selection that you could be assigned. Yeah. It's easier, Marcus, it's easier to defend. This is one of the reasons I like a in the money. If you can avoid the stupid assignments. Let's talk about the out of the money. Okay? You sold an out of the money that you collected 18 cents on. To really profit, you need the thing to expire out of the money, because where's it really going to go from 18 cents? You got 88, what did we say, 82 cents at risk. So the 18 cents could potentially go against you relatively quickly and become 25 or 30 cents, you know. And then you're sitting going, okay, I sold this for 18. The general rule on credit spreads is they're not over till they're over. You know, so while they can cycle and rotate, they can go against you, but then go back to working again. A lot of people like Karen on the Tasty Trade thing, she's willing to accept that. She and all those guys are. They're willing to say, hey, you know, I sold it for 18 cents, and it's not working until it's not working. And just because 3 days from now my 18 cents is at 30 cents doesn't make it a non-working trade. It makes it a trade that you have to look at it and say, can I absorb selling something for 18 cents or 180 bucks, and now it's at 30 cents and it's 300 bucks it's worth, and I'm down $120. That's the question on adjusting the trade. Can you be down 120 bucks? You know, you got to remember you took the trade on initially with an $800 and something risk, so you have to ask yourself, can I take on that risk? Here's why I like the in the monies, if I could get these fools to quit assigning them to me. Because when they assign them to you, you lose your little game you're playing with your options, because now you got shares. If we sell one for 89 cents and it only risks 11, if it starts to go down at all, if SPY goes from 211 down to 209, these options are going to start to fall apart. And that 89-cent credit you collected may go down to 50 cents. So now you're already up 40%. You can ask yourself, well, I don't have to wait on expiration for this thing to totally expire, worthless, under 207. I sold it for 89 cents. And right now it's only worth 50 cents. So I'm going to close it and catch my 49 cents and get 100% win on my trade. So when you have the larger, when you're in the money and you have the larger credit collected, you have something negotiable is what I call it. You got 89 cents worth to play with. And the most you can lose is 11. Well, when you're on the other side of the trade, how much negotiating do you have with 11 cents? You know, if the spreads on these things is 8 cents or 6 cents, you don't have anything. You need it to close out of the money for both strikes to go worthless, and you keep 100% of your credit, or in this case, 18 or 11 cents, whatever it was. So you don't have anything to play with. Whereas if you play the flip side like I am, and you got a week or 2 or 3 weeks on the trade, and you collected 89 cents, if SPY pulls back a little bit, you know, we got a difference on those two deltas of an 85 delta on the 207 and a 79 on the, you got a 6 cent delta. So you're going to get 6 cents off there for every bucket move. So if it drops a couple bucks, you're going to pick up 12 cents plus 1 gamma, which is another 7. You're going to pick up 20 cents. So, you know, if you got a couple weeks up plus 1 gamma, which is another 7, you're going to pick up 20 cents. So, you know, if you got a couple weeks on this thing and the SPY comes down a couple bucks, you know, those premiums are going to get crushed with the theta, the difference between the net deltas, and the gamma coming into the second dollar. You know, all of a sudden that 89-cent premium you sold is going to be worth 50, 60 cents. You can sell it for 100 or almost 100% win. So you're not basically, in answer to a question that was asked from Marcus on how do you defend it, on the out of the money, you defend it based on what your risk tolerance is, knowing what you risk going into the trade. And in that case, that one way out of the money, I think, was paying 12 and risking 88 or something. So you're saying, okay, I got 88 at risk, or 880 bucks. when do I close that trade based on my personal risk tolerance of being wrong? And that may be at 30 cents. You may say, okay, I'm down 120 bucks. I can't take this anymore. And you get out. If you're playing at the money, again, you collected 50 cents. You're risking 50 cents. Of that 50 cents, what's your risk tolerance? You say, okay, if I lose 50% of this trade and it goes down 50%, that's only worth 25 cents. That's where I'm balanced. So now you've defined your exit point for that at the money. On the in the money one, assuming you don't get assigned and you only have 11 cents at risk, there's not much to manage. You let the thing either work or not work, because the spread's big enough that your 11 cents is not going to get you out for 3 or 4 cents. You're going to say, okay, it's got a 5 or 6 cent spread, and I've only got 11 cents at risk, so there's nothing to manage from that standpoint as far as a risk, because I'm willing to risk the entire 11 cents that the trade, gets out of the money. Where you manage that one, assuming you didn't get assigned, is the 89 cents you collected. You say, okay, here's my risk management. That's at 89 cents. When and if that goes to 50 cents, I'm going to take my 49 cent or 39 cent profit and call it a day on that trade. So now you're managing your reward and you're leaving your risk alone. On the other two, you're managing your risk, and that's it. Uh-oh, Karen is? All right, did y'all understand that? So what we covered tonight is the levels of approval for trading options, where you need to be able to trade options. Then we covered the benefits or selling or buying calls and buying puts. We covered the benefits of trading spreads versus long calls or long puts. And then we went through debit spreads on how to play a directional trade. From a debit standpoint, and then we covered how to play credit spreads at 3 locations, one at the money, one in the money, and one out of the money. JD, on the put side, you do the exact same thing. You would sell one and buy another and want it to close above. So in this particular case, what you would do is you would, on this, we'll take the 212, you would sell that one. Yeah, a bull credit spread. You would sell the 212 for $1.78, and you would buy the 211 for $1.25. You're collecting 50 cents, so that's about right, 50 cents, because you're at the money again. And if it closes below the 211 strike, you realize the max loss of 50 cents on it. If it closes above the 212, you get the max gain on it. So it's the same process as what's going on the other side. I do both. Sometimes you have to choose one over the other based on where the price of the stock is trading or the underlying. Because to get at the money, if it doesn't have 50-cent strikes like SPY and them do, to get at the money, you may be forced to go to one side, a call or put, just so you can get yourself closer to at the money. So like, especially on the 250 strike spreads and the $5 strike spreads, like, the ones like Tesla and stuff like that. You're going to want to choose the side you want to be on and get a little better debit cost on your spread based on how close it is, price-wise to the actual underlying where it's trading, especially if it's, a $5 strike. All right, so we covered all that. I'll give you a little quickie bonus here if you guys want it. An iron condor. I know you guys have heard that term a bunch of times. I do not, because I play in the monies, and the credit is really good, and the amount I'm risking is really low. Again, the probability of success is really low also. When I put those on and I go out a few weeks, like I did with AAL, if I can make 89 cents and I risk 11, I don't adjust it, I don't change it, I don't roll it out to another month. I don't mess with that stuff when I'm only risking $110 on the trade. I let it, it's an either or situation for me, kind of like the open interest trades that I share with the room on. They either work or they don't. Now, a lot of my trading is designed around that, and if you know how to trade well, you can get away with that. If you're fairly new to it, you're not going to be able to get away with it. If it works, great. If it doesn't, whatever. Because your risk tolerance doesn't allow that. So in this case, yes, you can roll those out a month. You can roll them up a strike. There's all kinds of stuff you can do. But if you read up and listen about credit spreads, in most cases they tell you to leave it alone or bail out of it if it goes into your risk level that you can't tolerate anymore. So in my case, where my risk is nothing, there's no bailing. It either works or it doesn't for me. In your case, if you're the guy that played the out of the money one, collected 18 cents and risked 82, you're going to have to do something if it falls into your risk tolerance. And say your risk tolerance was 40 or 50 cents. Then you're going to have to do something. You can make an adjustment on it, or you can roll it out. Or there's a lot of things you can just get out. Most of the videos you watch are going to tell you get out because you're in a trade that you allowed yourself to go into that has a maximum risk on it that far exceeds your risk tolerance. So you shouldn't have gotten in it to begin with. Yeah, Joe does. Joe. Is he still around? Yeah, Joe W. Daryl Joe does that. He plays SPX. He does a lot of SPX, credit spreads, and he plays in that 10% probability of success of going against him. Yeah, let me show you an iron condor real quick. Condor. What an iron condor is it is two credit spreads. You want it to stay. Let's say SPY's moving sideways. It can't get past 212, and it just doesn't go under 210. And so you look at your chart and say, it just doesn't happen. It always bounces off 210, and I'm just using these as numbers. You look at your chart and find those numbers, okay? What the iron condor is going to do for you is it's going to collect you a little more premium as a credit to define a range that you feel like it'll stay within. Okay, so for purposes of making it simple, let's use 209. So we get you want to get out a ways, you want to stay away. You don't want to play what they call too close to the fire, because you're going to have a dollar risk if you do a $1 strike variation on these iron condors. So in this case, you're going to sell two credit spreads. You're going to sell one on the put side, and let's say you just looked at your charts and said it doesn't go under 209. It just absolutely does not go under 209. So you're going to sell that 209 put for 60 cents, and you're going to buy the 208 put for 41 cents. So you're collecting, what, 19 cents? Say basically 20 cents. So you're selling a 209 on the put side, and you're buying a 208, okay? And you're collecting 20 cents. Now, if you played that as a credit spread by itself, your risk reward is just like I told you. You're collecting 20 cents. So you have 10 contracts, you have a $200 reward. You're risking $800 or 80 cents, but your probability of success is pretty good. You're needing it to stay above 209 and ultimately above 208. So as a credit spread, as a put credit spread, you're risking 20 cents to lose 80 cents. I mean, you're rewarding 20 cents to lose 80 cents. So by itself, that's how that play stands out. But you say, okay, it never goes below 209, but it also never goes above 212. So you flip over here to the call side. Okay, you've already put this credit spread on, and yes, you can enter these as a single trade with your broker. You can enter it as an iron condor. And you come over here and you say, okay, it never goes above 212, so I'm going to sell the 212 call at 67 cents. I'm going to buy the 213 call for 35 cents. Where's my Daryl at? He can do the math. So we're selling one at 67, and we're buying one at 33. What's the credit on that one? Thank you. Good number. All right, so on the call side of our iron condor, we did a credit spread that collected us 34 cents. And on the put side, we did of our iron condor, we collected a credit of 20 cents. So we got 54 cents in our pocket. Our maximum risk on this is the same $1. The difference between the 208 and the 209 strike if it were to go completely under the 208, or the difference between the 212 and the 213 strike, which is the same $1 if it were to go above the 213. So we've collected 54 cents and we've risked 46 cents that one of those two scenarios plays out. So as an iron condor, we've done two credit spreads with the same dollar risk, but we put 54 cents in our pocket. And we're telling ourselves, okay, we want to see it stay above 209 and below 212. That's our range. We need to stay above 209, 212. We've got a $3 price range in there. If it stays within there, then everything expires. And you keep your credits. The put side becomes out of the money. The call side becomes out of the money. And all four legs go worthless, and you collected 54 cents for that. So what you've done is you've increased yourself a higher credit amount, but you've narrowed your profitability zone down to 209 to 212. That's where you can win with that trade. That makes sense? I don't remember who asked me to do that. No, because you have a short leg and a long leg on both sides. They offset each other. If you did, now, you know, Lloyd would do what's called a naked straddle. He would sell the 209 put naked and collect the full 60 cents, and sell the 212 call naked and collect the 60 cents. And put the $1.50 in. This is how he plays UVX. Put the $1.60 in his pocket, actually. So he's putting $1.60 in his pocket. He's got two naked calls, or two naked positions, a naked put and naked call. That one uses some margin because your risk, you haven't put a cap or a ceiling on it. So your risk then lies in that it goes under 209 above 212. You have unlimited risk on the call side. Obviously, on the put side, it can only go to 0. But it can go to infinity on the other side. So your risk is going to be defined by how many contracts you play based on the value of that. So in this case, you naked sell a 209 and do 10 contracts. Your margin is going to require that you can take, you know, 10 contracts of SPY at $209 into your account. So the broker is going to make sure their butt's covered on that. That make sense? All right, so I don't really want to, how long we got here? Now it's 2 hours where I draw the line. So, I can ask you if you got questions. I know this is a lot to absorb. That's the benefits of being in the room, and we videotape this stuff and make webinars out of it. It's a lot to absorb. Obviously, you can tell it comes second nature to me because I've been doing this for so long, and I've done a lot of options classes. So while it seems simple to me, it can still get confusing when you're looking at your option chain. Even when you have experience, you're looking at it, and you got to think a couple times at things and say, well, wait a minute, how do I do a credit spread, or how do I do a debit spread? Uh-oh, I think I just locked up. Hang on. Ooh, that was good. That was just a computer went to sleep. All right, so, you know, I have to take a second look at things sometimes, you know, because they flip-flop both sides, call side, put side, and you got to look at it for a second. It's okay, I want to do a credit spread, so what do I need? I need to sell the 210.50 and buy the 209.50. I need to close above. You know, so there's a little bit of reverse thinking going on here when you do debits versus credits. One thing to note, if you're bullish on the calls, or bullish on the SPY, and you play a call debit spread, and it actually works, and whatever it is you played, the 212, 213, regardless of what you paid, say I think we were at the 42 cent range, and we were paying and had a max of 458. If you win on that trade, both of those strikes are in the money, and you have to close that trade, okay? In most cases, you'll want to close that trade because there's some stipulations between you don't have to be assigned. There's something with the short leg. You have to be exercised on the long. While I'm the unfortunate one that gets the assignments, they don't have to do that. And you don't want to position yourself where the long position gets exercised and they don't necessarily assign the short. So if you play a debit spread, whether it's on the call or put side, and it goes in the money and the trade works successfully for you, close that trade out. You know, even if you can't get your full dollar, which you're probably not going to, even at the end of the day on Friday, the last 15 minutes, it's still hard to get the max of $1. You're probably going to get 90 cents, 92 cents. You know, they keep these premiums spread out enough so that, you know, you don't just, You don't realize the full dollar. And if you guys that are in here have traded these things, you'll know that. You can't just sit back and say, oh, I'm going to get my full dollar. I'll wait till Friday morning. It doesn't work quite that easy. So if you do a debit spread, you have to close it out. If you do the credit spread, that's why you'll see a lot of the guys doing these credit spreads. If you're right and it works, then both strikes are out of the money and there's nothing to close. So if a debit spread works, both strikes are in the money and you're fighting for the max you can get out of that dollar that it was supposed to give you, and you get 92 cents, and then you got to be careful, especially if it's trading close to the strike, because the last thing you want is for have a spread on and one leg to stay in the money and the other one to go out of the money. You know, and you're trying to fight the thing for 2 or 3 cents at the end of the day on Friday. You don't want that. You don't want one to stay in the money, one to go out, because now you got an exercise or an assignment potential, and you were trying to change your 90 cents to 92 cents, and that 2 cents isn't going to be quite so important to you anymore. So you're not going to get a max dollar on that thing. The only way you can get your max trades on Friday is if you did the credit spread, and it works, and both strikes go out of the money, and there's nothing to close. And the flip side is you don't have to pay the commission to close it either, nor are you fighting it. That's assuming it goes in the money enough that it's not hanging around one of your strikes on you. If it's hanging around that strike, get out of it then also, because again, you don't want one to stay in the money and the other one to go out of the money. So if it's around your winning strike that you sold, and the long strike and stuff, if it's around there, get out of the position. If you can get 90 cents or 92 cents, take it and call it a win. Because there's been too many times I've tried to fight that thing for the balance of that dollar that I felt like it owed me, and got myself in a little bit of a pinch because I played too close to the fire. And you only got to do that a couple times, and you're like, oh, okay, 10 contracts a SPY. I played too close to the fire. One's in the money, one's out of the money. Here I sit, you know, and I was fighting this stupid thing for 3 cents. You know, on 10 contracts, you know, big deal. It ain't worth it, trust me. Yes, and that's the other thing. There's a lot of brokers that have software that can analyze the trades that they have internally in their platform, and some of you guys that don't have the money to take an assignment or take an exercise, the broker will pick up on that, and oftentimes I see it. I've never had it happen, but oftentimes they will early close some of these option spreads on you, and you'd be like, what the heck happened there, man? My broker closed it. They're not going to position themselves where your mistake can fall into their hands. Right. You got 15 minutes afterward to get yourself out of a pickle. But like I said, if you have an account that could not handle it, don't be surprised if there's a lot of brokers you're not going to be able to even put this trade on. If you want to try to day trade, scalp one real quick at the end of the day, they're not even going to let you put the order in. But they're also going to, if your account can't handle it, they're going to sell that order on you. And if it's playing real close to the fire or the strike, they're not going to let you be in charge of whether you let one stay in the money and one go out of the money, and depending on what you're doing, take an exercise or an assignment, they will close that spread for you. And sometimes you're going to be like, doggone it, I had a potential to make $1 on the thing, you know, and it was at 80 cents and they closed it on me. And that'll happen about 15 minutes before the market closes. So with that, keep that in mind also, that if you're fiddling around towards the end of the day on Friday trying to max that trade out, they may shut that thing down underneath you. Right. Count goes to zero. They collect commission. All right, so I covered everything I want to cover, doing the little extra bonus thing on the iron condors. Let's do this. From a standpoint, I think we answered quite a few questions here also. From a standpoint of videotaping this for a webinar, I'm going to end it now. I'm going to get a drink of water. I'll still be around. There's some other people in here that can answer questions. From a video standpoint, I'm going to end the webinar. It'll be available on YouTube in a few days. It takes a little while for us to get them dumped up to the Omnibius or the webinar sites and then put them on YouTube. But we did video record it. 2 hours and 3 minutes long. I know I go long on these things, but I try to make them really super informative, and I try to bring them to a level of someone that knows nothing. I try to start there. And that's a challenge. If you try to take something and teach it from, that's like a teacher teaching first grade to 12th grade. That's essentially what I'm doing here when I do these things. I'm trying to teach kindergartners all the way up to 12th grade people, because you're teaching people that don't know anything and you're teaching people that are super experienced. So it's a little challenging and it can run lengthy in the process, but I feel like I accomplished what I'm trying to do. So I'm going to shut the video off. I'm going to go get a drink and we'll still answer some questions. Shut that off.